How can you improve your credit score? Does a single missed payment really stay on your credit file for 7 years? And how many credit cards should you have, if any? We'll answer these questions and more on this, the 18th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, welcome to day 11 now of the 31-day money challenge. We're about a third of the way through. I hope you're finding these podcasts helpful and useful. It's been very interesting to try to pull them all together, interviewing different folks, trying to come up with content that I think will help everybody make the most of their money. Yesterday, we started to look at credit scores and just sort of the basics of them, why they're important, how a FICO score is calculated. Today, what we're going to do is talk more about how to actually build a credit score and improve it. And we have on the show Maxine. She is the credit expert at Experian, one of the three major credit bureaus. So she'll give us sort of the inside scoop on credit reports and credit scores and how to improve your credit. So she'll be on the show in just a little bit. We also have a great question from a listener named Perry. It actually dovetails nicely into the topic today of credit. And I have a news item that I want to share today as well, dealing with an investing topic. So before we get to all of that, let's quick shout out to the sponsors. The first is Betterment, an online platform that invests your money in both stocks and bonds. You just pick the percentage you want of each, and Betterment does the rest. It even rebalances your portfolio for you and reinvests your dividends automatically. You can check them out at betterment.com. And Personal Capital, it's a free online software tool that allows you to aggregate all of your investments, taxable and retirement investments. It will quickly and in a very nice graphic show you your asset allocation across all of your investments, as well as the fees that you're paying, including the fees in your 401k, an important thing to know and to understand. You can check them out at personalcapital.com. All right, well, let's turn to the question first from a listener named Perry. And Perry writes, this is the question. So when you use 0% card offers to pay off your credit card debt and you have them paid off, then what do you do with that card? If you close them, it damages your credit. But if they are open, then the available credit goes against you as possible debt. So what's worse, closing them or letting them linger? Is there a good time to close them, like year-end versus mid-year? Well, that's a great question. And let me first say that the question of closing credit cards, there's a couple of different factors that I think you ought to look at. Your credit score is just one of them. Now, that's the focus of Perry's question, and so that's what I'll focus on. But, there could be other reasons to close a credit card. But to focus on Perry's question, the first thing to know is this. If having an unused credit card, that is to say you've got a credit card with some limit and you have no balance on it, that actually does not hurt your credit. In fact, it can help it. And the reason it can help it is something that we've talked about yesterday, and that's credit utilization. It's the amount of your available credit that you're actually using. That is to say, how much debt you actually have in comparison to your total credit limit. And the lower that percentage, that is to say, the more available credit that you have, the better as it relates to your credit score. And if that seems odd, the rationale behind it is a couplefold. One is, if you have all this available credit that you're not using, that tells the FICO formula and the other credit scoring formulas that, one, you can manage your available credit very well. You're not maxed out. And the other thing is it's an indication that if something were to happen, you were to have an emergency, you have the available credit to deal with it. And so keeping your credit cards open, even after, for example, in this case, a 0% offer, it's exactly what my wife and I did. We have a number of credit cards that we used years ago to transfer high interest debt over to them. And I don't use them anymore, but I've just never closed the account. And that actually helps our credit score. Now, in my case, frankly, I haven't closed them at this point simply because I just haven't taken the time to go close them. It's not really so much to try to keep our credit score up, because I think, given my age and how long I've had credit, closing a couple of credit cards is not going to, in my case, hurt my score. But if you're trying to keep your credit score up, maybe you're not, I guess, not as old as I am, and so your credit file hasn't been around as long. Maybe you're thinking of buying a home or refinancing a mortgage. You really want to be careful about that. So the available credit, that is the credit that you have that you're not using, does not go against you as possible debt, as Perry had asked. So, by the way, one other thing is, when I get these credit cards in the mail every couple of years for these accounts that I no longer use, I just cut them up and throw them away. I don't want to leave them lying around. I have no use for them. I have one primary rewards card that I use, that my wife and I use for all of our monthly expenses and big purchases in order to get the best rewards we can. But for these other cards, I just cut them up, and I suppose at some point I'll take the effort to actually close the accounts. I just haven't done it. So that's the answer to Perry's question. And we'll actually talk about credit utilization a little bit in my interview with Maxine. So in terms of the news item, and I'll leave a link to this article. This is another CNN article. We talked about one yesterday, and this one, the title of it is this: Stocks, Bonds, ? In 2014, Think Cash. And I read this article, and it's a thoughtful article, but I think it's extremely dangerous. Here's sort of the background to this article. Interest rates, as everyone knows, have been at historic lows, really for a number of years now. And if you think even big picture, they've kind of generally been coming down since the late 70s, early 80s, when, and this may be hard for some to believe, but mortgage rates were double digits and inflation was double digits. I remember having a certificate of deposit in, I want to say, around 1980, that was earning me double-digit interest rate, which sounds great, except that that it's great for a saver, but for a borrower, it was just misery. And really, since then, interest rates have, of course, they go up and down, but just in big picture, they've been moving down to where we are now. They're basically at historic lows. And so, as the Fed starts to ease up on their money policy and start to eventually increase rates as unemployment goes down and hopefully the economy improves. Many economists and others are predicting that interest rates will start to rise, and most kind of think it'll start to happen this year. I don't know if that's true. It makes sense the predictions, but who knows? But here's the thing: as interest rates rise, the value of existing bonds goes down, right? If you've bought a bond, you've invested in U.S. debt at, say, a 10-year bond at 2%, let's just say. If tomorrow, all of a sudden, new investors can get that same bond for 4%, well, the value of your bond or a bond that I own at 2% is going to go down. Who wants to buy a bond that only earns 2% when they get a brand new one for 4%, right? And so that brings down the value of bonds, and certainly that it has a big impact on bond mutual funds. And the same can be true of stocks. Generally, as interest rates go up, the value of assets, all other things being equal, go down. And that's true of any asset, not just stocks, because if you think about an asset, what's its value? It's the present day value of its future cash flows, and you have to discount those future cash flows back to today, and you use a discount rate, and that discount rate is going to be influenced by the current interest rate. So as interest rates go up, the discount rate you use goes up, and the value of those future cash flows goes down, which I'm going all the way back to my days of economics in college. Really, the long and short of it is this: as interest rates go up, more people invest in fixed income. They invest in CDs. They invest in what are viewed as safer and less in stocks. And so that brings the price down. So anyway, so back to this article, the talk was, okay, we think interest rates are going to go up. What should we do? And I was surprised at all these recommendations, move money out of U.S. stocks, move money out of small cap stocks, move money into foreign stocks. And then at the end, it was even, take some, I like how they talk this, take some money off the table, cash in some of your stocks and just have it sit there in cash. What did they say? Here we go. Given today's stock and bond valuations and the fact that interest rates are bound to rise, quote, there's nothing wrong with pulling 10% off the table and sitting in cash, end quote, says James Stack, a market historian and editor of the InvestTech Research newsletter. Well, there is something wrong with that. I mean, the reality is we don't know what the market is going to do. We don't know what interest rates are going to do. And here's the real question. If you follow this advice and you start cashing in some of your stocks and just let it sit in cash, when do you put it back in? When do you decide that interest rates are done rising and now it's time to go back in and repurchase the stocks or the stock mutual funds that you've bought? I read this article. I think it's horrible advice. It's certainly not what I'm going to do. And we're going to, as we move through this month, we're going to talk about asset allocation plan and finding mutual funds and ETFs. To execute on an asset allocation plan, I'm going to share with you all of my investments, not that they're necessarily perfect or right for you, but at least to give you an idea of how I think through this. But I think the idea of trying to time the market is generally a very poor one. We're just not good at it. I mean, frankly, if you'd asked me, and I think a lot of people, 2 years ago, if interest rates would still be as low as they are today, most would have said no. Most thought interest rates would have gone up by now. And they hadn't. So in any event, that's my take on it. If you have a different view, feel free to share it. Just go to speakpipe.com/DoughRoller. You can leave a voicemail and let me know what you think. I will leave a link to this CNN article in the show notes. So that brings us to the interview with Maxine. I hope you find it helpful and informative. She obviously comes with excellent credentials, having worked at Experian for quite some time. So let's now turn it over to the interview. Maxine, welcome to the show.
Hello. Thank you for inviting me.
Well, we're thrilled to have you. Having a credit expert from Experian it's like kind of getting the inside scoop on credit reports and credit scores. So I'm thrilled that you were able to take the time to talk with us. Just as a beginning point, why don't you just tell everyone a little bit about your background and how you got into this crazy business of credit reporting and credit scores?
Well, I tell the story from way back. I went back to get my master's degree a long time ago and went to the student placement office, asked there was a job, and they said, well, there's a job at the credit bureau. And I said, what is a credit bureau? And so many years later, here I am. And then the more close-at-hand story is that at one point I managed our consumer assistance operations where we helped consumers get a copy of their report and dispute. And I really worked hard to improve service levels and do everything I could to help consumers. And there was still, this was a while back, and consumers still didn't really see us in a positive way. And I said, the problem is the only time consumers have visibility to us is when they've been turned down for credit, and they never see that when we help them get that car and walk off the lot, or we help them get that instant credit in the store. So we need to be more active and more out there helping them see that there are real benefits to having a credit report, and there are benefits to our making it available instantly, because it doesn't just help the creditors, it helps them. So I've been in the public education part of Experian ever since.
Okay. How long have you worked at Experian?
35 years.
Wow. Okay.
Yeah.
Well, it's interesting. You mentioned sort of the consumer-facing side of Experian and the industry, because I remember in fact, when we bought our first home, my wife and I, which was in 1993. It's really, of course, before the internet as we know it. You couldn't just get online and check your report or check your score. I had no idea what my credit score was, and or how credit scores were calculated. And at some point, and maybe you can fill this in a little bit, but at some point, the whole sort of credit reporting and credit scoring industry seemed to turn towards consumers. So instead of just sort of dealing with the creditors and giving them information so that they can make underwriting decisions about credit, there seemed to be this turn towards consumers to give consumers information about credit reporting and credit scores. When did that sort of change happen?
Well, it really started happening in the 90s, and it was one of those, it got triggered by service getting very bad, frankly. And that was in the late 80s when credit just took off. I mean, before, everything had been very local. You went to your local bank and got your car loan every 4 years, and they knew you, and, it was a different world. And then in the late 80s, the credit took off, and pre-approved offers were being mailed out all over the country. Regional banks, national banks were first having coverage everywhere. And the credit reporting companies simply got overwhelmed because there were so many consumers coming to us at that point because they'd been turned down and wanting copies of their credit report that we were giving terrible service. Like, you had to write, first of all. There was no toll-free service. So everybody had to write, get a copy of their credit report, and it would take us, 2 weeks to process them because we'd be so backlogged. And there was no online service, of course. So consumers were really unhappy with us, and rightfully so. So we, as an industry, started at that point going, we've got to look at this in a different way and find a better way to help consumers. And I am proud to say I was a part of that. And that's what I was saying is I made all these wonderful changes, but I still didn't feel that we were reaching consumers in the right way. Like, I put in 3-day service, and you might notice that turned into law eventually. But 3-day service is our limit, that we had to get a credit report mailed out within 3 days. There was no limit on, it was a reasonable time period for processing disputes. And I set the standard that we had to get it done within 30 days. That ultimately became the law. So all of that started happening in the early 90s. And, of course, technology helped us along a lot.
Right, sure. Okay, well, let's kind of dive into it. Sort of the focus today. In the podcast that I published yesterday, I talked about credit scores in a more sort of high-level way, why they're important, how a FICO score is calculated, and things like that. I kind of want to dive down into a little more detail today in terms of how folks can actually build and improve their credit. But I think it's sort of a foundational question is, what's the difference between a credit report on the one hand and credit scores? Can you help us with that?
Yes, and I think that's really an important place to start because so many people don't understand that. And the main message is that a credit report does not rate your credit, even though we're often called a credit rating company. We're not. We just simply lay out the facts. So the users of the credit report needed some way to be able to interpret that information. What does it really mean to them in terms of risk? And so credit scoring was developed to fill that need. So it's really a two-step process. We provide the report, and then it gets scored along the way if the lender requested it be scored, and the lender chooses which scoring model they want to use. So then it can be either applied by us as we deliver the report. It might be applied by them on their end in their application processing system. It might be a scoring model that was produced by FICO, one of many of theirs, or one of the Vantage scores, or one from Experian, or one from any other model development company, or one developed by the lender themselves. Some of them have custom models that are applied there. So the bottom line to all that is, whenever we speak about improving your score, that's really the wrong way to say it, even though I say it too. You're not there's no score sitting there to be improved. There's only a score at the moment it's created, and it's based on the information in your credit history. So the right way to think about it is, you're not trying to improve your scores, you're trying to improve your credit history so that when it is scored, it will score better.
Okay, well, that makes sense. So the report is all of the details, what credit accounts you have, whether you're making timely payments or not, all of the data. And then a credit score, whatever formula is used, basically is a way to take all of that data and summarize it in a single number.
Exactly.
Okay.
Like grading a paper.
Right. Okay, that makes sense. And, one thing you mentioned is, there's different kinds of credit scores. And so my first question is, does Experian have its own credit score formula?
Yes, we have a division of Experian called Decision Analytics, and we develop some specialized scoring models, and we help some of our lenders develop customized scores. So it might be that a lender might use a one version of a FICO score and also an Experian bankruptcy score. They may apply two scores to the application.
Okay. And does Experian have a score that it offers to consumers if they want to have a sense as to what their credit score is from Experian's point of view?
We do. The Experian Plus score is the one that if you purchase our monitoring service under freecreditreport.com. I'm sure you've seen those commercials on TV. They're quite well known. And that is our own score that we developed and provide to consumers through that service. We also provide scores to consumers through our Consumer Assistance Center, but in that case, we provide the Vantage Score 3.0. So you have an opportunity to be exposed to two different scores.
Okay. And I know just from my own research, and then I also did an interview with Tom Quinn from FICO, that even though sometimes we speak of a FICO score, the reality is that there are many versions and variations of the FICO formula. There's not just one FICO score. There's many. And, I think in talking to folks, all of this sort of becomes overwhelming. It's like, wow, this is, complicated. But I wonder do you have a sense, or maybe there's data out there you can point me to and I can link to it in the show notes, but what percentage of creditors use, say, some form of the FICO score versus other types of scoring formulas?
I don't have percentages on that. I do know that for mortgage lending, most of them use the same FICO model for consistency in that industry. But beyond that, it's like for car loans, there are custom scores that are focused on car lending. There are custom scores focused on credit unions if you're doing business with credit unions. So beyond the mortgage industry, I would say it's very variable. There are some lenders who use the Vantage score exclusively, like Kohl's, but there are some that use FICO in some cases and Vantage score in some cases. So the main message to consumers is that you don't focus on that you've got a number and that number is going to be the same for every lender you go to. Any score that you get, let me repeat that you get is educational. And that means that it's only meaningful for that one model, but it tells you what in your credit history is most negatively impacting that score, so that you know if you need to improve your scores, what to focus on. And if you change that part of the way you use credit, improve it, then it's going to change all of your scores whenever your credit report is used.
Okay, good. Well, that's helpful. Well, let's kind of get down into the details then. And I want to start with folks who are, just out of high school or college. They're just starting out. They don't have a credit history. As a result, they don't have a credit score under any formula. How do folks start out and build a good credit history and good credit score? How can they do that when they're sort of starting from the very beginning?
And before I go there, one of my soapbox issues of late is the parents who are, quote-unquote, protecting their young people from credit. And I say that that's like trying to protect your child from drowning by not teaching them to swim, because we all, in today's economy anyway, need credit references in the same way you need academic references, job references, character references. You need character references. And so trying to protect your child from that is really doing them harm in the long run, and saying, I only let them have a debit card. Well, a debit card doesn't build those references. So better that you help your young person start those references. And one way, of course, to do that is to add them as an authorized user or a joint user on one of your accounts if you pay your accounts on time. And then another way is to co-sign, and that means that they are the young person is responsible for the account, but you have to be very aware that if they don't pay, you are totally responsible as well. And it will show up on your credit history and be a part of your debt, and et cetera. So if you really want them to start without your having to be on the line for them, the other way to do it is to do a secured card, and that's where you open a savings account with a bank or credit union, and make sure you're going to a reputable one and avoid companies you don't know online, because there are some scams out there. But you deposit a certain amount of money, and it basically guarantees the amount that's on your credit card. It's usually a smaller limit, but it gets you started. And you can't withdraw the money from savings as long as you're using the card. And then typically, if you're with a reputable company, after a while, if you demonstrate that you can manage that well, they'll move you into a regular credit card. and that starts building those references.
Yeah, that's a lot of interesting details in your response. And I know the question about credit, particularly for folks just out of high school or in college, it can be a hot topic. And by the way, if you're listening and you have a strong opinion one way or another, you can leave me a message at speakpipe.com/DoughRoller. I'd love to hear your opinion on that, and I'll play some of those in future podcasts. I know for my wife and I, we have a son and a daughter. They're 19 and 20. And at the moment, they don't have credit cards. Now, that's not because we've told them they can't have one, but at this point, there's just not a need. But we're already discussing, Maxine, to your point, you can't build credit with a debit card. So, what's the first step? I do think the whole authorized user, if the parents have good credit, is an excellent way to begin because, the young adult doesn't actually have to go out and use a credit card for that to help their credit, which to some may sound odd, but that's the way it is. You mentioned secured cards too. The one thing I like about that option is credit limits are usually very low. They're limited to what you deposit for the card. So, if you keep your credit limit low, you're not going to be able to rack up a bunch of credit card debt.
Yes, and let me jump in and quickly say too, when I'm a very strong advocate for having credit cards. And I am even stronger advocate for never having a credit card balance revolve. In other words, you should never build debt on your credit card. A credit card should be used for convenience, to earn points, to have positive cash flow. You pay at the end of the month, to have a bill that you can track exactly where you spend all your money, all of those positive things. But if you are carrying debt on your credit card, you're spending more than you can afford. So, when I say parents should help their kids get credit cards, at the same time they should be helping them learn to use them so that they're not ever using them for debt.
Yeah, I'm so glad you mentioned that. I mean, that's a great point. It's something that I preach here on this podcast and on my blog. The other reason, too, is just security. I think of the whole issue with Target here recently. And,
exactly.
With a credit card, your potential liability is limited by federal law. And so, okay. So that's some good tips on how folks just getting started might be able to build credit. One thing that comes up a lot is this business about credit utilization and how it affects credit scores. Can you kind of tell us what credit utilization is, and if there's some ideal level of credit utilization in terms of keeping your score high or improving your score?
Yes, and I'm glad you brought it up because it is a really important factor in scores, in all scores, no matter what kind of score. They all look at how much you owe on your credit cards compared to how much you could owe. In other words, your balance to limit ratio. And they look at not only each individual card and determine that ratio. They add all of your credit cards together and determine the ratio. So, if you have a limit of $1,000 and you owe $800, that's a very high ratio. So if you are using one card that way, even if you're paying it in full every month, that $800 is going to show as your balance. So what you need in those cases is you need several other cards where you're not charging a lot. If that's the one that you use for everything, for your groceries, for your gas, your whatever, so that it's going to have that high balance. You need other cards with very low limits that will offset the high usage or high utilization on that one card, and so that your overall utilization will be low. And as for the magic number, it used to be, to keep it below 30%, and I still think that's a good rule of thumb, especially for young people just starting out, because they're not going to have very high limits. But as you mature and get more cards and higher limits, ideal credit scores will be down below 10% even utilization. So that should be an ultimate goal.
Okay. You said something that was new to me, and I've spent a lot of time looking at credit utilization. But you said that, if I heard you right, that the formulas look both at the utilization rate on credit cards individually and also in the aggregate. Is that right?
That's correct.
I had not realized. For some reason, I just assumed they looked at your overall credit utilization. I hadn't realized that they also factor in your utilization on a card by card basis.
Yes, both. And and that's why you really warn people not to close on cards that you're not using if you have high utilization. If your utilization, your other credit's very strong and deep, and you don't have any problems, then don't panic about closing a card you don't need, especially if you're paying an annual fee for it or something. But otherwise, the goal should be to build up several credit card accounts so that you have that overall low utilization.
Yeah, my wife and I ended up with a number of credit cards with fairly high credit limits because when we were climbing out of credit card debt a number of years ago, we would transfer the debt to 0% balance transfer cards, and we would just, I don't know that it was intentional, but we never closed the old cards that we had transferred the balance from. And so maybe it was just by accident, but we ended up with a handful of credit cards with a pretty significant amount of credit. I suppose I could go back now and close some of them. I just never have. But
we just did a state of credit. Experian just did a state of credit analysis where we looked at credit scores and debt and other characteristics by age group. And the younger age group, of course, had the lowest, lower scores. And the greatest generation had the best scores. They have that long, rich history. And that's the other thing about closing accounts. Eventually they'll fall off, and so you'll lose that older history. So that's another reason to consider. But anyway, the millennials had a very high utilization, and it wasn't really so much that their debt was so high. It was that their limit was so low.
Okay.
They just didn't have very many credit cards opened. They only would have one or two at most. And so that was part of why their scores were lower.
Interesting. Well, is that analysis that you mentioned published online?
It is.
Okay.
You can go to livecreditsmart.com.
Uh-huh.
And there's not only that information, but a lot of good information out there.
Okay. I'll include a link to that in the show notes. Another factor that we read a lot about, and this makes sense, is that your payment history, that you pay your debts on time. And I'm curious, can you give us some insight into? Well, the first question is this: what constitutes a late payment? In other words, if someone is, 10 days late on the payment of a credit card or a car loan, will that show up in an Experian credit report as being a late payment?
Typically, no. It could, because you are late. But typically, the standard in the industry is that they will only report you as late on your credit report if you are a full payment past due. So, in other words, if your payment was due on the 15th of December and by the 15th of January you haven't paid it, then they will report you as one payment past due.
Okay, and then how significant is that from a credit scoring perspective? Well, if you're just one payment past due on a credit card, let's say, is that going to have a significant impact on your credit score?
The answer to every question like that is it depends, because it depends on all the other.
You sound like a lawyer, and that's coming and that's coming from a lawyer. That's my favorite answer when clients ask me what the law is.
Well, it's actually my most frustrating answer, because whenever I ask our scoring technicians the questions, that's always what they say to me. Well, Maxine, it depends. But unfortunately, it's true. But it depends on all the other parts of your credit history. For example, I obviously have a very long, rich history with many credit cards. I have, paid car loans. I have paid mortgages, and I have enough good credit out there that I can offset something if I happen to stump my toe and miss a payment. It wouldn't affect me very much because I have so much other strong stuff. Now, if your son or daughter who only has one credit card misses a payment, well, you can imagine that would be much more significant and drop their score much more significantly. But in any case, missing a payment is always negative. And the worse you miss it, and the more recently you miss it, and the more times you miss it, will all be more significant. In other words, if it was last month, that's much more significant than if it was 2 years ago. And if it's like you miss one and then a few months later you miss another, that's significant. And if you go 60 days, 90 days without paying, then you get into major derog, as we call it, major derogatory items. And that's where you start phasing into, they'll charge it off to bad debt. They'll post it for collection. if you get a judgment against you for a financial obligation, all of those will be really, really serious. They stay on your credit history for 7 years, and they will be negative for the entire 7 years.
Well, I suppose there is somewhat of a silver lining in all of that, and that is if you've missed a payment or two, it may stay on your report for 7 years, but then if you fix things and you're paying on time, as those missed payments get older and older, they have less and less effect on your score.
Absolutely. And that I'm so glad you brought that up, because one of the things that I try to point out to people is that I have an advice column called Ask Experian, which is another resource for your listeners on our Experian.com website. And so if any topic that you have a question about, you can go in and use our search engine and find it. But I get a lot of people who write to me and say, well, I got into trouble, and so I just closed all my accounts and I'm swearing off credit. Well, that is absolutely, if you ever are going to need credit again to get a car or to get a house, that's the absolutely worst thing you can do. Because what you've done is you've frozen your references in that negative status, and that's all you've done. You've just frozen them there. Mm-hmm. So if, and this is the big if you can continue to use credit without getting into debt with it, if you can just use it a little bit for your gas or your groceries or something that you know you can pay every month, then what you're doing is you're adding positive points every month, and that's offsetting that negative in your past.
Okay, good. Well, I wonder, we talked about missed payments in terms of, the recency and how many times you miss. Does it matter what type of payment you miss? I mean, for example, is missing a mortgage payment versus missing a credit card payment, do they have the same effect on your score, or do they have a different effect?
There's some fine-tuning of that. If a credit history is being used for an auto loan, it will probably weight missed car payments more heavily than another kind, vice versa. But I wouldn't say that there's a huge significant difference. They're all going to be a negative, and so you just, if you have to choose between which one you're going to miss, then choose it based on something other than what it's going to do to your credit history.
Okay.
Try to figure out how it affects your life.
Right, good. Well, what about someone who's had a more significant event like a bankruptcy, a foreclosure, or short sale? Can you give us just some rough idea of one, how that impacts a credit history and a credit score, and then two, how does someone come back from that kind of event? How long will it take them to rebuild their credit file and their credit score after something significant like that?
Well, a bankruptcy is the most negative, and that's because you are writing off your debt. A Chapter 7 bankruptcy will remain in your credit history for 10 years, and 7 is where you write off everything. A Chapter 13, which is where you have a repayment plan, will only stay for 7 years. So, but there's still going to be a negative impact for a very long time. While judgments and collection accounts will also stay for 7 years, they're not quite as negative as a bankruptcy. But and now bankruptcy is more challenging with this. But again, the trick is, if you want to recover, is if you can leave a credit card open and out of the bankruptcy. And sometimes that's not possible, but if it is, that's the best way to start rebuilding. And VantageScore has a white paper out on their site that shows a chart of how long it takes to recover from a negative like that. And in one case, you don't go back to being a plus prime score person, but you can get back up into at least an average score or above average score in 6 to 9 months if you can keep using.
Did you say 6 to 9 months?
Yes.
Wow, that's pretty quick.
Yes, that's pretty quick.
I wonder if you could send me a link to that white paper you mentioned.
I'll be happy to.
Oh, that'd be great. I'll include that in the show notes.
Okay, great. But that's where if you aren't able to keep a credit card open, that's where you need to start building your savings back up and get that secured card and sort of start all over again.
Right. Well, if someone's gone through bankruptcy, is there a set time limit where you've got to wait at least, X months or X years before you can even conceivably qualify for a home mortgage?
I am not an expert on mortgage approvals, and so I would recommend that people talk to someone in the mortgage industry. And for other kinds of credit, it totally depends on the lender, the creditor. They have different standards for that, and some are willing to take a chance on you more quickly than others. So it's really one of those where you need to reach out and talk to the lenders.
Okay. You'd alluded earlier, I think, to sort of monitoring services. But if folks want to monitor their credit score, I know there are a lot of different options. I use Credit Karma and Credit Sesame. I know my FICO has a monitoring service. Does Experian have a credit monitoring service?
We do. Ours is best known as freecreditreport.com or freecreditscore.com.
Right.
Yeah, freecreditscore.com primarily. But of course, it's very available on our website at Experian.com as well. And so that people say, oh well, you're advertising it as freecreditscore.com and it's not really free, and so I'm not defensive about that. It's definitely there to attract you to come and check it out. But if you get there, you will see that you're definitely signing up for a service. And so what I say to people there is, if you can afford it and you're interested in monitoring, it's a great service. I personally have it and I love it. One, it gives you peace of mind. I quite honestly was a part of the Target thing. I had shopped there. I'd used my credit card, so I was very interested to see if I would have any activity. But I didn't have to worry about it because I knew I would get that early warning.
Oh, you're talking about the data theft from Target? Okay,
yes,
from Target, right?
Yes, uh-huh. So so I just know all the time that if anything happens, I'll get that early warning. The other thing is that many people find it helpful if their scores are not good enough, and they're changing the way they use credit, trying to get better scores so that they can qualify for a better rate on their mortgage or car loan or whatever. And, it's another way to track your progress.
Right.
So yeah, I definitely recommend it for those two reasons. If you can afford it and you're interested in the service, it's great. We also have another service that you can find on our website. It's called the Credit Educator Service, and this is where we do credit counseling. Basically, even people that I work with who say, I know a lot about credit reports and credit scores because I talk about them all the time. And then we will offer, they will go through our credit educator counseling session, and they go, I can't believe how much I didn't know. So if a consumer is interested in just getting an in-depth coaching on their specific credit report, their score, what's impacting their score, what things they can do differently, they have to sign up for an appointment. We have to wait the 3 days before we can have the appointment from the time they set up the appointment. There's a fee of about $30, and but there's no time limit on how long. If they need more time, less time, we'll help them as long as they need. And so that's also a great service that we get rave reviews about. And we've seen that it definitely increases scores for consumers as we track them over time.
So for $30, a consumer can get on the phone with a credit expert at Experian who will literally walk through their credit report with them and explain, whatever questions they have. And I mean, is that basically how it works?
Exactly.
Okay.
Exactly.
Great. Well, how about as we kind of come towards the end here, one question that I think vexes a lot of people is they pull their credit report. You can get the credit report for free, of course, every year from each of the three agencies. And, you pull up your report and you see mistakes. Maybe it's just about your identity. I sometimes pull up my report and it shows me as living at an address where a business partner of mine lives, for example. But sometimes the mistakes are even more serious, where maybe there's an account that shows up you never opened, or perhaps a creditor is reporting a payment is late that was not late. How can folks resolve these sorts of errors and disputes with Experian?
The easiest way to do it is online. I mean, if you go to our online service, everything is very easy. I even have a video out there that walks you through the whole dispute process. So if you want to, you can take a couple minutes and watch that through. But it will step you through the process. If it's and that's just for simple dispute things. If there's something that you need to speak to us about, you always need to start with a copy of your Experian credit report. And we ask you to do that so that you're looking at a current copy and you're looking at the same information we're looking at. And, of course, you can get it from annualcreditreport.com, or if you've been declined or, based on an Experian report, you can get it at Experian.com. Did I say annual? Yeah, annualcreditreport.com. That's where you get the free report once a year. But once you've got that report, you can look in the contact information section. There'll be a toll-free number you can call and enter your report number, and then you can speak directly to a person. And then just one more thing on that. I just want to remind everyone that you're not disputing, it's not Experian who is determining whether your information is right or wrong. You're disputing through Experian. Our role is that we collect the data and store the data and make it available to you when you want services. But we're not the judge and jury on whether you're right or the lender's right. We want accurate information. So try to kind of think to yourself, if you see something wrong on your credit report, of like how that might have gotten reported to Experian. And in some cases, you may need to contact the lender directly and say, why do you have this in your records about me? And what can I provide you so that you clean up your records and then report it not only to Experian correctly, but to all the credit reporting companies? Because your goal isn't just to get it fixed in your Experian credit report. Your goal should be to get it fixed at the source so that then it's always reported correctly. And they're not going to be coming after you for a debt, that you think because you got it off your credit report that you don't owe anymore, and they still think you owe it.
Yeah, that's a really good point. I mean, I had an issue with a cell phone company where I had canceled the service, but for some reason they kept showing it as me having not paid my bill, and I would call them up, and they would dig in. Oh, I'm so sorry. We'll have that taken care of, and they wouldn't. And then I'd call them back. Oh, that's and it went on for about 6 months. It was very frustrating, but I knew that I had to resolve it at the source. It's because the credit reporting agencies aren't going to come in and say, okay, I think Rob is right here, or I think that right. But and it was frustrating, and there were times when I wanted to give up, but eventually we got it worked out. So I think that's a very good point. It's if you see something that's an issue, I think folks should absolutely report it to the credit reporting agency where it's listed. But it's also important to reach directly out to the creditor and try to resolve it as well. That's a great point.
Yeah, and many times, if you dispute it to us, problem, we check with the source and they look and they correct it or whatever, but that's not, like I say, ask yourself, why did it get reported to us wrong in the first place, and is there something that you might need to do to help make sure it gets, because if they just look at their records and it says the same thing it always said, then they're just going to verify it, and then you're going to be mad at us.
Right.
Because we didn't change it.
Well, the thing is, it's just so frustrating. Personal finance and investing is complicated enough, and then when you've got inaccurate information on your credit report, sometimes it just feels like no one's listening or cares, and that may not be true, but that's how it feels. And you're going back and forth between the reporting agencies and the creditor, and you just want to pull your hair out. But I think if folks stick with it, they'll eventually get to the right outcome. It just can take some time. So. Well, Maxine, before I let you go, I always ask guests on the show what their favorite personal finance or investing book is. Do you have a favorite you can share with us, or just one that you think had a profound effect on how you manage money?
Okay, well, this is going to be a longer answer than you want. But
No,
I have
okay.
quite a few friends and colleagues who've written books, so I might get in trouble if I picked out a particular one.
I won't tell anyone.
Just between you and me, right? But I have to tell you, there are two main messages that I have for consumers, and that is, one is that you need to have credit cards, more credit cards, but never have credit card debt. So if you've got debt, you need to pay it down. And the other thing you need to do is you need to save. You need to save for short-term tires, new water heater, mid-range, vacation, college, and long-term retirement. And so from there, write your own book. Because different things work differently from everybody else, or for everybody. Like what works for me doesn't necessarily work for my sister. And so I say, look at what works for you to accomplish those two things, and then you write your own book.
Very good. All right, Maxine. Well, listen, thank you so much for taking the time to share your insights into credit reports and credit scores. Really, really appreciate you coming on the show today.
It was my pleasure. Anytime.
Well, I hope you enjoyed the interview with Maxine. If you have, credit scores I find them to be a confusing and complicated topic, even though I've studied and written about them for years now. So if you have questions, please email me. Just shoot an email, dr@DoughRoller.net, and I'll do my best to answer them. If I can't, I know I can forward a question to Maxine or also Tom Quinn, the credit expert at FICO, whom I interviewed in podcast number 2, and I know they'll both be happy to help answer your questions. So feel free to send in a question. The other thing I would say is, one thing I stressed at the beginning of this 31-day money challenge is that we really need to think for ourselves. No matter what information we get, whether it's in this podcast, a blog, a website, we need to ask ourselves: does this make sense for me? Is this the right choice for me? And I think that's so important, rather than simply taking someone's advice, particularly on matters of money, and following it blindly. Don't do that. You need to question everything. And so I was thinking through the interview with Maxine, and one thing that she said is that her view is that you really want a lot of credit cards. And it's interesting because, as I mentioned earlier in the show, my wife and I have a lot of credit cards because of transferring debt to 0% balance transfer offers. We've just never closed them. But I'm not so sure having a lot of credit cards is the best answer for everybody. I mean, I think of my children who, are just out of high school a couple of years. And, if they came to me and said, "Dad, I think I'm going to go out and get 6 credit cards," I would say, whoa, hold on there. I would not think that's a good move at all. And I'd try to talk them out of it. Part of it, of course, is their age, and they don't have experience yet with credit. And my big concern, as you might imagine, would be that they'd come back, 6 months later with 6 cards maxed out. And so this is just an example of, figuring out what's best for you and making the best decision, for your situation, for your family situation. So, take what you hear, consider it, use it, but question everything and make sure you make the best decision for you. Well, that brings this show to a close. You can get the show notes to this podcast. Just go to DoughRoller.net/podcast 18. You can leave a voicemail for me at speakpipe.com/DoughRoller. Just leave your first name and any question or comment that you have. I'd love to hear from you. As always, you can email me at dr@DoughRoller.net. I read every email and I respond to every email. You can subscribe to this podcast. Just go to DoughRoller.net/iTunes. It'll redirect you to the iTunes page where this podcast resides. You can subscribe, and please leave a review. I'd love to know what you think of the show, how I can improve it, what you like, what you don't like. And lastly, if you haven't already, you can sign up for our free weekly newsletter at DoughRoller.net/newsletter. We pack it full of tips to help you with your money every week. So until next time, remember, the best thing money can buy is financial freedom.